James,
How are you?
good. Good.
Doing well over there?
Yeah, month of March behind us. Where's the time going?
I know. Heading into April. March is come and gone. First quarter, 2024.
First quarter 2024 in the books.
Yeah, and wasn't a bad one.
No, I mean that's the thing. It's been so impressive.
Yeah.
Just this ferocious move to the upside in the equity markets, stock markets. So, from our vantage point, we'll take it.
Right.
And yours too.
Yeah, I was going to say it's been a different 3 months.
Right.
Kind of stringing them together. I guess kind of getting into that. If we look back at the markets.
Yep.
In March,
Yep.
What did they look like? What did we see?
To do that? Yeah, so we always reference the S&P 500, top 500 companies in the U.S. as measured by market cap, delivered to us yet another handsome move in the right direction, up. We saw the S&P 500 return 3.22% for the month of March, so a little bit north of 3.2%. And guess what? Our friends, the bonds, actually decided to participate a little bit. So the aggregate bond index was up just north of 0.9%. So not quite 1%, but hey, we'll take it. A lot of interest rate volatility out there. And if you've joined us before, you'll know bonds don't like that interest rate volatility, especially when rates go up.
And we've talked about that for a while.
Yeah, we've been talking about that for a while. And you know what? We'll probably talk about it again a little later. I kind of know our roll call here. So,
So one thing we've kind of added within these topics is, when we go from like the markets and what they've done, even, last month or last year, whatever it might be, but also kind of looking into the portfolio and how that might shape it or change it or keep it the same.
Yeah, I think one of the ways that you stay alive and continue to deliver that edge for your clients is going to be to understand what expressions need to live in a portfolio relative to the macroeconomic environment, the more micro details, and then just the mechanics of the market. Quite frankly, the market is a machine, and you have to know what's going on with the machine to be effectively using it, okay? So we wanted to introduce this section at the front of every podcast where we touch client portfolios. What are we doing in client portfolios at Advanced Capital? And these are general terms. Yeah. But when you think about it, what we're trying to do in portfolios is capture the robust nature of the move that really we started to see materialize back late in 2023. And so one of the things that you've got to do when you see all this fiscal stimulus coming out, remember we talked about liquidity? The places that liquidity is going to flow to, that's where you want to be, go bigger. So traditionally speaking, those are going to be in large growth-oriented stocks. So that's right here in the U.S. So that's going to be one of our heavier allocations in the equity sleeve of the portfolio, stock sleeve of the portfolio. We're not doing a ton outside of our borders. We're not doing a ton down in that mid and small cap space. There'll be a time and a place for that, but not necessarily here right now. And allocating in that large growth-oriented space, and you're diversified, don't get me wrong. But that's where we're going to lean into, and that's been producing for us. So that's been good. For those that are retired and need a different element, a different dimension of diversification, a different element of income creation, bond exposures, extremely important here. Remember, we talked about our bond friends decided to participate in the month of March. They haven't been participating all year. So it was good to see that interest rate volatility will continue to chop bond investors who aren't aware. It'll chop them up and spit them out. So what are we doing? We're making sure that the bond component of the portfolio is able to handle that interest rate volatility. Right. And this is an environment where you got to be very careful. Yep. And we'll cover that a little bit later. So that just gives you a flavor for what we're doing here. Yep. Again, we're trying to deliver that edge, and it doesn't have to be a huge edge. If we can deliver a reasonable edge to our clients consistently over time.
Yeah, that's what the difference is.
Bingo.
Yeah, that's where it starts to snowball. So looking at kind of where we might look at the markets and, whether there's the ability to add the edge or not. But if we look at how the market is structured and support, where do we think we are there?
Yeah. So in preparation for this podcast, one of the things that I mentioned was the market structure that you're seeing in that machine, if you will. recognize we're talking about a lot of stuff in the economy and whatnot. Yeah, it all matters, but you know what matters day to day is positioning of market makers, dealers, if you will, understanding where like gamma flips are and stuff. And I mean, there won't be a test on this, right? But the bottom line is there was a structure to it. And one of the things that is very convincing about the structure that we're seeing play out right now is as the market hits peaks and gets a little bit exhausted, where it's finding its digestion and then starts to create another run, you're getting higher highs and higher lows. So you're finding support sooner than you did in the past. And guess what that creates? A channel that looks like an uptrend, which is very important. You know, one of the less constructive ways of building a market to all-time highs, you hit that all-time high, and then you come and you break down below.
Right back down.
Right? And then now you've got a lower low, and you're kind of getting mixed signals where it's nice when a market can trend. So that's what we're seeing.
Yeah.
That's what we're seeing play out.
Well, that's good to hear that we got a little support there then.
You know, and again, this stuff, it's subject to change.
Yeah. Well,
and again, you've got to be very fluid and don't get stubborn with your investment thesis. You can't.
Mm-hmm.
Okay.
Stay on top of it, be movable.
I digress. Sorry.
That's right. M1.
Yeah.
Right. Years ago, we talked about the M1.
Yeah. Yeah. Well, that's right. It matters.
No. So talking about like that support, maybe how the economy actually flows, you kind of talked about higher highs and higher lows.
Yeah.
But if we're looking at how the economy actually flows through these different key words, key terms you hear on the news and you see on the internet, but what does that actually mean?
Right. So it's this diagnosis of like the bigger picture. You look for the market to kind of give you the symptoms and then overall your diagnosis and the treatment plan and what have you. Okay. So recognizing that macroeconomics, the market is going to manifest that macroeconomic environment. When does it do it, though? That's the big question. And if you get that right, you got something. But the bottom line, that macroeconomic picture, those are the things you see in the headlines. Those are the things that you're confronted with when you walk out of your house. I mean, the fact that I tell you the dealer gamma flipped at 5,200, you're going to go, what is this guy talking about? Right. But if I told you that you're paying more in the grocery store, you'd go, yeah, I know exactly what you're talking about. All right, so that's kind of what I'm referencing here. So when you're looking at that macroeconomic environment, typically the stock market, the equity market, is going to try to front run that. So whatever the macro is going to be maybe 6 months from now, that's what the market is trying to manifest right now. Mm-hmm. So, for instance, you saw the market hit prior all-time highs back in 2021, and then the real inflation hit in 2022. That was the market front-running inflation from my vantage point, okay? So here we are again. Markets hitting all-time highs due to a lot of fiscal stimulus. Well, guess what that fiscal stimulus will transform into? GDP growth. Guess what that GDP growth will translate into? People have, we have jobs with higher incomes. Then that demand will then manifest into higher prices. Those higher prices flow through to the inflation channel. And so understanding where we're at in that cycle is really important because then your portfolio would reflect what we're confronted with, not right this second, but down the road. Remember, 2021 was the last time we hit all-time highs, and then we had CPI running in the nines the year to follow. So one of the things that we've got to, I think, make peace with, inflation is not just going to evaporate away with the amount of fiscal stimulus that you're seeing. And it's this idea that it's not that the cup got any more valuable. It still's going to hold the coffee the next day. Didn't get a paint job, nothing. But the coffee cup cost me more? Well, it's not that the coffee cup really costs more. It's that the dollar is weaker.
Yeah.
Therefore, it takes more of them to buy the coffee cup. Well, what if we said that stocks are just ownership? It's just ownership of a business. So you own something, much like the coffee cup. So switch the coffee cup out for the stock in the business that you own. I mean, realistically, the business doesn't even have to get any more profitable. Mm-hmm. When that dollar depreciates, you'll find more value
in there. Yeah.
Bingo. And that'll look, on your statement, you're going to go, woohoo. Now, you go travel outside of our borders and have to convert that currency to some other currency, you might go, well, what in the world?
Whole other game.
But again, so I think that if we're thinking critically about where we're at, I think we have to be prepared for those inflation pressures to not erode away. And when that happens, recognize this, that there's going to be less disposable income for other things, and more disposable income will be tied up in the things that actually are very sensitive to inflation. So, that's kind of the big picture. We got to watch out for interest rate volatility here.
Watch out for that.
So we just touched on what are we doing in portfolios. It's going to kind of evolve around, or revolve around, I should say, our thesis going forward. So I think that that's a big chunk of what we need to be watching.
So if we look at those economy flows, right, is there anything else we should watch for? Or is that, really kind of what we're paying attention to right now for the clients?
Yeah. So
You touched on a lot there. I mean, that's what
I don't know if there's something specific you want to unpack there, but.
No, really. I think the next topic,
Yeah.
The people are really looking at, and we've heard some people ask what it might or how it might affect things, is the whole real estate thing. With the different commissions, or is it going to be in our best interest, or is it just going to cost us more money? Or
So I know where you're going with this one. Yeah. So one of the things that we just learned was that how realtors are going to be paid differently. That whole industry, how they're making their living is changing. And I guess we chose to bring this up simply due to the fact that it's, most of us own real estate, or we've owned real estate or plan to into the future. Yeah. So it kind of matters. Yeah. And although we're not experts on this front, recognize this. Anytime that a government authority gets involved in an industry, typically it's inflationary.
Yeah.
So in this instance, they're going to, change how realtors, or how the consumer pays a realtor for their professional expertise. And no longer is it going to be this kind of set percentage rate.
Yeah.
Probably the seller is going to still be confronted with a 3% commission, but then the buyer, in my opinion, probably how this is going to set up is there's going to be some sort of service charge at that closing level. And it probably will be dependent upon how large the purchase is. Yeah. But the bottom line is, this is just illustrative of real estate. Well, now guess what? More money can be tacked onto the price of the house because less money is going to the industry in compensation. So that right there could be inflation.
There you go.
Exactly.
Right back to the.
So I think that that's just something to build out a little bit, and for you to recognize that's going on in the real estate world right now. We're not experts in that space, but it is happening, and we do have to account for these things in our client portfolios.
Yeah. So, and that's kind of why we wanted to touch on it.
Yep.
So if we're looking at these last few topics, right, and we look at how we might want to stay productive, stay constructive. Both with, our portfolios moving ahead, producing income, being paid properly for risk.
Yeah.
What should we look at kind of as we head into April, head into this year, trying to stay productive and constructive?
Well, one thing to look at is we're looking at it.
Yeah.
So that's good. But I would just say make sure that your headspace doesn't move to a pessimistic view just because I hate to say it, but we have yet to really touch on the election cycle. But there's going to be a lot of politicizing the economy and things like that. Try not to steer far off of that because there's a lot of just data that really matters. And I think that data, it doesn't mean that things aren't going to roll over at some future date. It doesn't mean that we need to be paying very close attention to managing risk, but you have to take advantage of the environment when you're being compensated for risk.
Right.
And this is very much an environment where that relationship is alive and well. Doesn't mean there won't be volatility. It doesn't mean there won't be pullbacks and pullbacks, corrective movement even. In fact, maybe even April needs to be a light month because we need to set up for a strong finish to the year. But all of the makings are right in front of us to have a very robust year. So try not to go down the road of, again, a preconceived notion giving you an absolute outcome
Right.
to the answer you're looking for, because oftentimes it's not that. And with your investment portfolio, the other thing is recognize the things that are driving it. It's not what you walk out your door and are confronted with necessarily today, because remember, that's something that makes a lot of sense to us. Something that doesn't make as much sense is, what is the market doing?
Yeah.
All-time highs, but again, it's just that notion. So continue to tune into us.
Right.
We'll tease out the stuff that really matters, and when this environment changes, we'll try and let you know.
Yeah, sift through the noise.
Yeah, that's right. And that's a great way to tune it out.
Yeah. Yep.
Tune out that noise.
That's why you got us.
And stay committed.
So let's look ahead a little bit.
Yeah.
April, you mentioned the election, kind of things we're looking at,
Yeah.
kind of as we, even head into the next podcast.
Yeah, definitely. Well, it's just this idea that it's healthy for markets to take breathers. I think if you're looking at, I talk about data all the time, it's like if you're looking at rolling comps, so everything is reported for the most part in year over year. So like what's the 1 year CPI trending at? Sometimes it might be 3 months, sometimes it might be 6 months. Okay, fine. But this is mainly year over year. So one of the things that's really helpful is you just go back a year and say, where was that data point? And kind of think about where it's going to be now and recognize that both of those data points have relevance to what the number is going to spit out at. So, I think when we're thinking about the year, April might be perhaps the opportunity for the market to pull back that it might need to. But, you look out into the remainder of the year, it's pretty robust from where I sit today, and everything changes every single day, right?
Yep.
But in the same breath, I think we can be pretty constructive where we're at here. I will say there's a lot of hedging as I look at, hedging going out towards the election. And I think a lot of that has to do with the fact that it's such a tight race right now, for whatever stage of the race we're at. But, again, all things to be watching.
Yeah. We'll stay on top of it.
Absolutely.
We'll make sure we're there, and we'll look forward to seeing everyone next month.
See everyone next month.
Thanks for joining us. Advanced Capital Management Incorporated is a registered investment advisor. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor before implementing any strategy discussed herein. Tax and estate planning information should not be construed as formal legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Thank you, and we look forward to seeing you next month.